In the world of trading and investing, success often feels like chasing a mirage. Most people dream of becoming the next big short-term trading genius, but the truth is, very few ever achieve lasting success that way. The modern market has evolved into something far more complex, and humans are no longer competing against other humans, they're competing against machines. Today, algorithms dominate trading floors, scanning data, interpreting headlines, and executing trades faster than any person could react. In this environment, old methods like gut instinct and technical charts often fail. What once worked is now obsolete, and traders who refuse to adapt risk being left behind. The recent global market crash was a wake-up call for many. When Donald Trump announced a 100% tariff on Chinese imports, panic rippled across the financial world. The S&P 500 fell sharply, nearly 3% in just days. Tech stocks took a beating, and fears surrounding regional banks triggered even more selling pressure. Billions of dollars in market value vanished almost overnight. What started as a political move quickly exposed how fragile global markets have become. Human traders, already struggling to keep up, were once again reminded that emotion and reaction are no match for algorithmic speed and logic. Macro analysts have started calling this a structural reset, not just a temporary correction. Artificial intelligence has changed how markets function at a fundamental level. These trading systems don't just follow market trends anymore, they help create them. Algorithms analyze sentiment, detect liquidity gaps, and execute millions of micro-decisions in milliseconds. In a world like this, hesitation is not just costly, it can be fatal to your portfolio. Behind this technological shift lies a deeper transformation. The very fabric of our economy is being rewritten by artificial intelligence, automation, and robotics. The traditional rules of productivity and growth are no longer as reliable as they once were. Population growth, once a driver of GDP, is slowing across major economies. Aging populations reduce spending and productivity, and governments are forced to print more money to sustain growth. That endless printing of currency, essentially debt monetization, weakens purchasing power and inflates asset prices. Stocks, housing, and especially crypto have soared as a result. But soon, this equation will change again. Artificial intelligence and robotics will replace human labor as the primary source of productivity. Instead of limited human workers, we'll have an infinite number of digital and robotic, productive units. The implications for the economy are staggering. Economic growth could explode, but who will capture that value? And if machines do most of the work, what happens to traditional jobs? For many traders, these questions feel overwhelming. The same uncertainty extends to investing itself. How do you price companies in a world where AI makes decisions faster and better than any human analyst? How can a trader compete with systems that never sleep, never panic, and never second guess? Humanity is about to lose its position as the apex of intelligence. For the first time in history, there will be something on this planet far smarter than us, and it will reshape everything from markets to labor to human purpose. The best way to prepare for this coming transformation is through adaptability and financial security. The more secure you are, the more flexible you can be when change comes. That means building wealth steadily, avoiding reckless risks, and investing in long-term trends that will shape the future, such as artificial intelligence, blockchain technology, and decentralized systems. Over the past decade, crypto has become one of the fastest-growing asset classes in human history. Its potential lies not just in price movements but in its role as a hedge against currency debasement. By holding quality assets like Bitcoin or Ethereum over the long run, investors can ride the broader macro trends that are reshaping global finance. The key, however, is discipline, not gambling. Many people chase quick wins, 100x returns, and viral tokens, but that mindset often leads to ruin. If your goal is to change your financial future, you must approach the market like an investor, not a gambler. One of the simplest and most effective strategies is to divide your capital into separate portions. Keep the majority, say 80 to 90%, in long-term positions that you believe will perform well over time, such as major cryptocurrencies or strong tech equities. Then use a small portion, maybe 10 to 20%, for short-term trades if you want the thrill or experience. This way, your core wealth compounds steadily while still giving you some flexibility to experiment. Over time, your long-term holdings will likely outperform any short-term wins. Most people find it hard to think long-term because social media encourages a constant focus on daily price movements, screenshots of profits, and the illusion of instant success. Crypto Twitter, for example, is filled with short-term noise, traders bragging about catching tops and bottoms, showing temporary wins that often vanish later. It's easy to get caught up in that cycle, but real wealth rarely comes from it. It comes from patience, understanding macro trends, and letting time work in your favor. Another critical point is to avoid excessive leverage. Leverage tempts traders with the promise of multiplying returns, but it just as easily multiplies losses. Using 20x or 50x leverage might look exciting, but the odds of losing your entire account rise dramatically. Even professional traders struggle to sustain leveraged positions over time. A modest amount of leverage, perhaps 2x or 3x, can enhance returns without catastrophic risk, but anything beyond that turns trading into gambling. Over decades of market observation, very few short-term traders have managed to build lasting wealth. Most successful investors adopt a longer time horizon. They identify structural trends, like currency debasement, aging demographics, or AI adoption, and position themselves accordingly. Trading is about reacting to noise, but investing is about anticipating change. The biggest macro trend today remains the expansion of global money supply. Governments continue to print currency to manage debt and stimulate growth, which naturally reduces the purchasing power of fiat money. This process drives up the value of scarce assets, stocks, real estate, and especially cryptocurrencies. Over the last 12 years, this factor alone has explained the majority of movement in major indices like the Nasdaq and Bitcoin. Understanding this single macro driver simplifies everything. If money printing continues, asset prices rise over time. It becomes less about day trading and more about identifying which assets will appreciate the fastest under these conditions. In that race, cryptocurrencies like Bitcoin and Solana have consistently outperformed. Smart investors look for assets that have both proven resilience and growth potential without being too far out on the risk curve. Comparing one asset to another helps identify the fastest horse, the one likely to deliver the best returns relative to others in the same environment. For instance, shifting from Bitcoin to a stronger performing altcoin during specific cycles can yield better results without taking extreme risks. Cycles themselves are another crucial piece of the puzzle. The global economy tends to move in repeating 4 to 5 year patterns driven by debt refinancing, interest rate policies, and liquidity flows. Many assume these cycles are unique to crypto, but they influence all asset classes, from stocks like Tesla and Amazon to commodities like oil. Recognizing where we are in that cycle allows investors to position accordingly. Ultimately, long-term thinking remains the most powerful edge any investor can have. While machines dominate short-term trading, humans still excel at recognizing big-picture shifts and adapting strategies for the future. Building capital patiently, diversifying intelligently, and aligning with megatrends like AI and blockchain create resilience in uncertain times. For most people, the smartest path is simple. Focus on earning stable income, save diligently, invest consistently in high-quality assets, and avoid the illusion of quick riches. The thrill of day trading might offer temporary excitement, but long-term investing offers lasting freedom. The future will bring massive economic growth and unimaginable technological change. AI will redefine every market, every job, and every industry. But despite that uncertainty, one truth remains: human adaptability. We will always find ways to create, evolve, and build value. The key is to ensure your decisions today prepare you for that future, so when the world changes, you're not left behind but ready to thrive in it. This shift isn't something to fear, it's something to prepare for. The investors who succeed in the coming decade will be those who understand that time, discipline, and patience are the greatest edges left in the market. Long-term thinking will always outlast short-term noise. The question is whether you're ready to think ahead, build wisely, and make choices your future self will thank you for.